Welcome back to Market on Close. We have less than 10 minutes left in the trading day. Time now for the big picture. I want to welcome in from our team at Charles Schwab, Kathy Jones, Chief Fixed Income Strategist, Schwab Center for Financial Research. Kathy, it's always great to hear from you. Let's kind of talk big picture in terms of where we're going this week. PCE, the headliner for the week in terms of economic data. Yes, we have a slew of economic data coming up, but that's the star this week. What are your expectations for the print?
Yeah, based on the numbers that we have from CPI and PPI, we're looking for up 0.1% on the core PCE and about flat on the overall PCE. On the core, that brings it down to 2.6% year over year, which is a really low reading, the lowest for this cycle since it's been falling. It's also happens to be what the Fed's summary of economic projections forecast for the end of the year. So we might be hitting it mid-year rather than waiting till the end of the year.
So if it hits that level, let's say for core, it now becomes 2.6%. What does that tell you about the implications for the Fed's path forward?
Yeah, we have penciled in 2 rate cuts by the Fed, another 50 basis points for the end of the year. We think the first cut likely in September. And the reason is that, the Fed is going to follow inflation lower. They need confidence to do that. And I think a couple more months of low readings on the inflation numbers would help do that. Also seeing some softening in terms of consumer spending. We might see some of that in the Q1 GDP numbers that we get. It looks like consumer spending may be running only 2%, which is a pretty sluggish rate. Not bad, but pretty sluggish. And then, of course, you have the upturn in jobless claims, which may give us a softer jobs market. So we think if all those things fall into place, we get a September rate cut and maybe another one before the end of the year.
With you just mentioned jobless claims, with the softening that we're seeing there, although overall the labor market's been holding up, what do you expect that influence, or how much do you expect that to influence the Fed's path?
Well, employment's a big issue for the Fed, obviously, and they put that on the back burner while they're addressing inflation, but it is part of the dual mandate. And what we're seeing on the employment side is all of the leading indicators of employment have rolled over and come back to normal. So whether it's the JOLTS numbers talking about job openings relative to job seekers, whether it's the pace of employment growth. When we look at some of the private sector indicators like Indeed.com, they're all showing a normalization. And then we're also seeing a slowdown in wage growth. Now, it's not as low as I think the Fed would like to see it. Wage growth is running a little over 4%. I think they'd like to see 3%. But if we continue to see some of this uptick in jobless claims, which is the kind of high frequency data, I think the Fed will respond to that before we get the unemployment rate, significantly above 4%, because the last thing they want to do is cause that to accelerate to the upside.
All right, let's talk a little bit about kind of the expectations when it comes to the consumer piece of the puzzle. Personal spending is expected to show a slowdown, consumption expected to show a slowdown. What does that do to kind of what the broader economic picture looks like from your point of view, Kathy?
Yeah, I think it suggests that, we had this burst in consumer activity kind of in the first quarter, started end of last year, the first quarter kind of threw off our expectations, but now it seems to be settling back down. And what you see when you look at the consumer is credit card debt is high and delinquencies are rising. Now, writ large, most consumers are still in pretty solid shape, but it's those consumers kind of on the edge that are starting to feel the pain. Seeing a slowdown. So the retailers, I'm sure you guys have talked about this a lot. Retailers like Walmart starting to cut prices. McDonald's starting to offer different meals so they can get that lower income consumer back in the door because prices were too high. And car loans, auto loans, a lot of delinquency on the auto loan side. Other insurance costs really high. So all of that's pinching the low to middle class, not the upper middle and upper class, but The lower to middle class folks are having a tough time, and that tells us that consumption is likely to come down and the economic growth is likely to be sluggish.
Let's talk a little bit about the fixed income market in particular. The 10-year drifted a little bit today, but what's your expectation for the balance of the year when it comes to yields on the 10-year and other fixed income metrics that you're watching?
Yeah, so we're looking for, if we're right about 2 rate cuts by the Fed, then we would look for sort of a bull steepener in the Treasury market, with short-term rates falling faster than intermediate and long-term rates, but the whole curve shifting a bit lower. So we're looking at 4% or so on the 10-year between now and year end. It wouldn't be that hard if we do get those 2 rate cuts to get there on the 10-year. But a lot of the rally is likely to come in the shorter part of the curve, where it adjusts more quickly to Fed rate cuts. So we are looking for yields to just drift lower in the Treasury market. And then, other fixed income markets where you're still seeing a pretty nice yield going out, where the yield curves are flat to upward sloping. You're still looking at pretty close to 5% in a lot of those markets, like agency MBS and investment grade corporates. Those will probably come down as well. Although those yield curves are, the IG market, the yield curve is flat to upward sloping. So it's probably more of a proportional shift down rather than, a shift in the yield curve.
All right, Kathy Jones with expectations for yields on the 10-year and beyond. Chief Fixed Income Strategist for the Schwab Center for Financial Research. Thank you, Kathy.